It's time to start thinking about your portfolio in 2023, but with so much negative news out there, it's difficult to decide where to invest. So I start off by looking at some broker forecasts for next year, and then I look across different asset types, sectors and countries to see where there may be value. And then I finally draw it all together by suggesting some potential tilts for your portfolio. Now don't forget, if you do enjoy our content, please do subscribe to our channel because it's free, and that way you won't miss any new content. So let's look at where to invest in 2023 in a bit more detail. Let's begin by focusing on the US market and analyst forecasts for the S&P 500. Below me you can see the S&P 500 since the beginning of 2017, that's the blue line, and I fitted a trend growth line here, that's the dashed red line. Now you can also see for every year I've plotted analyst forecasts which were made at the end of the previous year. So here are the forecasts for the end of 2020 which were made at the end of 2019. Notice that everybody was too bearish, only one forecast actually managed to get close to where the S&P ended that year. And in 2022, all the analysts were simply too bearish. The incredible returns we had that year simply topped all expectations. Then in 2023, it looks as if we're going to be well below even the lowest expectation at the end of last year. Now, what's really notable about the end of 2023 is that all of the investment banks which have made a forecast are actually getting very bearish. The central case for the forecast is around 4,000, which is roughly where we're ending the year. So in other words, no growth at all for the S&P 500. If we do use that trend growth model, which since 2017 has been a growth rate of just under 10%, you can see that that would put the S&P 500 above 5,000. That's well above any of those forecasts. If we extend the period over which we look at the S&P, you can see the trend growth is actually much lower, around 7.5% if we go back to 1990. And if we extend that trend, it actually puts us almost directly in the middle of the forecast for this year. So I really wouldn't put too much weight on those forecasts. They actually form more of an exclusion zone for what actually happens than forecasting accurately what will happen to the S&P. It's also helpful to look at valuations for US equity. Robert Shiller, who came up with the cyclically adjusted price to earnings ratio, has actually created a new version called the excess cape yield, which adjusts for the level of interest rates. The basic idea is that when interest rates are very low, as they have been until recently, then it's an excuse for equities to have higher valuation. So the excess cape yield adjusts for the level of interest rates to see when stocks are expensive or cheap. So the vertical line you can see here is the value of cape right now, because cape is along the x-axis here, with expensive on the left of the graph and cheap on the right of the graph. So you can see that at the moment, we're getting kind of close to the expensive part of the graph. What you can also see on the y-axis is the following decade returns for the S&P 500. Now, as you'd expect, when the S&P 500 is cheap, you tend to get higher returns. When it's expensive, you tend to get lower returns. However, the current value of the excess cape yield provides very uncertain outcomes. The dispersion of these points is absolutely huge. These valuation measures tend to be most helpful when they're at extreme values. If we look at the value of the excess cape yield over time, that's what you can see here. The periods when it's blue show when the S&P is cheap, and the periods when it's red show when it's expensive by this measure. And the average value, or the median, is around 3.5. That's the central black line here. And you can see the current value is 2.44, which is verging into the expensive part of the graph. Not super expensive, that would be below the dashed red line, but still far from cheap. Now, cape and excess cape yield use earnings from the previous decade, so they are a backward-looking measure. Another valuation measure I like is the forward price to earnings multiple. Now that looks at the price of the index divided by the forecast earnings over the next 12 months. Now, of course, that's a guess, but it does incorporate all the latest information. And what we can see is that at the beginning of 2021, valuations were very high, roughly 21 times earnings. But then what happened is that equity re-rated downwards as stock prices fell, and now it's below its 5-year average, that's the dashed green line, and it's roughly equal to the 10-year average. Now, I'd say fair value would be the long-term average, which is a 15 times multiple, which it almost reached earlier this year, but not quite. And we've had a big rally since then. So in summary, the US equity market is looking not particularly cheap, but certainly not incredibly expensive. And that's important because when valuations are very high, it tends to give lower returns over the next 5 to 10 years. Now, the key thing to look at when we're looking at valuation is how much profit the stock market's generating, or in other words, earnings. This is the quarterly earnings for the S&P 500 since 2013, and it's broken down quarter by quarter. The blue line shows the historic earnings, and the red line shows the forecast earnings for the next 6 quarters. And this data comes from FactSet. So you can see the effect of the pandemic here, as we had a very sharp fall in earnings, but really that just lasted 1, 2, 3, 4 quarters. And then very rapidly we got this huge bounce back in earnings. And that justified some of the very strong rally we had after the pandemic. It was fundamentally driven in part. However, notice what happens after that is that we get a stabilization and a flattening of profits. Now that is not good for stocks. I think you can see that more clearly if we look at the year-on-year growth in those quarterly earnings. Again, you can see the pandemic fall here of 32% in Q2 of 2020 with a huge upswing that followed. Now that upswing has completely worn off and we're starting to get these very small quarterly earnings. You can see that for these 4 quarters, starting in Q3 of 2022, effectively earnings growth has stopped. Now that is not good for the US stock market. And it's possible that broker forecasts will revise those down even further. Brokers always tend to be a little bit too optimistic, and it's only when they're staring recession in the face that they downgrade their forecasts. So this is a definite negative when we're looking at the stock market for the US a year ahead. If we look at valuations beyond the US, and in this graph we're looking at the CAPE ratio, so that's the value of the stock market in that country divided by its profits over the previous decade, which is roughly a business cycle. But what this shows is the current CAPE relative to its own history. So what this tells you is what percentage of the time that country's been cheaper as measured by its CAPE ratio. So the expensive countries are on the right and the cheap countries are on the left. And for example, you can see that India has been cheaper than it is currently 87% of the time. And the US has been cheaper 3/4 of the time. So these 3 countries, the Netherlands, India, and the US, but also to some extent Australia, Switzerland, and France, are all looking relatively expensive on this measure. The countries which are looking cheap, for reasons that we all know, are countries like China, but also Japan, because in the past it traded at huge multiples during those huge surges in its stock market in the 80s. If we look at the UK, that's not looking particularly cheap, certainly by this measure. It's been cheaper than it is right now about 39% of the time. So if you are a contrarian and you think these markets have been temporarily depressed by bad news, then this could offer you an opportunity to buy a country which you like at a good valuation. And if we look at those CAPE ratios over time, you can see how India and the US are way above countries like the UK and China. Now, the other measure which I like to look at is forward price to earnings, which we did for the US. And here is the same measure, forward price to earnings multiples, broken down by country. And this is as of the beginning of December 2022. Now, the top 2 countries are India and the US. They both look relatively very expensive, but now Japan actually looks pretty expensive as well. So this is why it's useful to use more than one valuation measure. So if we look at the UK, it's now the 3rd cheapest country amongst the ones in this list. Only Italy and Brazil are cheaper. So again, the way you treat this information is to say, are there any bargains out there? And do I expect this country to be temporarily depressed in price? And will it recover in some time horizon? Remember, this isn't like a single stock where it may not recover. Countries always recover in the end, unless there's something catastrophic like a revolution or political collapse in that country. Now let's look at individual US sectors. If we look at the returns by sector in the US over the course of this year, you can see that every sector except for energy has effectively fallen or been flat like utilities over this 12-month period. Energy has essentially saved the US stock market from a much more severe fall. This also applies to profits because if we strip out energy companies, the US has already had 2 successive quarters where earnings fell. So the huge surge in energy prices has been hugely beneficial to the US, which is now a big provider of oil. However, what we've seen recently is that energy prices have started falling quite sharply. And if that trend continues, then this backstay of the US equity market will start to be pulled away. And that's a worrying outcome for the US equity market. Now, one of the biggest drivers of markets globally this year has been the Federal Reserve's monetary policy. If we look across asset classes, which I've done here beside me, you can see the effect of each monetary policy announcement from the Federal Reserve on returns. Again, the only fund which has gone up significantly over the course of this year is USO, the US Energy Fund. Every other asset class is down on the year. The defensives haven't gone down as much, so gold's only down a little bit, so are short duration US Treasuries. But as we increase the riskiness of the asset type, you can see the sell-off has been bigger, until we get to Bitcoin, which is down by over 60% over the course of the year. The dashed red lines here are the monetary policy announcements. January had no hike, then we had 25 basis points increase in March. That ramped up to 50 basis points in May, and then we had 4 successive 0.75% increases. Now that's a shockingly large increase and a very rapid increase in tightening of monetary policy. Now generally that tends to be negative for risky assets. So when the largest central bank in the world aggressively raises interest rates, you can see it has a big dampening effect on risky investments such as equity and real estate investment trusts and junk bonds and all of these other assets. So the key question now is, when is the Fed going to stop raising interest rates? And is it actually going to start dropping interest rates? Will it pivot, in other words? You can see the market-derived probabilities of what the Fed's going to do at each of its monetary policy meetings here. And this is from the CME FedWatch tool. So each of these is one meeting date. This is December of this year, February next year, then March, May, and so on until the end of 2023. And the cell which is shaded in blue shows you what's priced in as the most likely policy rate at that meeting. Now, what's most likely for the December meeting is actually a 0.5% increase. Then the first meeting of 2023 would be another 0.5% increase, followed by a 0.25% increase, which is what the Fed usually does. But then notice that the Fed's going to hold the rate constant according to these probabilities. That'll be until July of 2023, when, according to this, the Fed's going to start cutting rates. Personally, I think that's quite unlikely. If we compare what the Fed says it's going to do, that's what these dots show, with the red dot, which is what the market says it's going to do, they're actually in pretty good agreement in 2022. You can see the market, the red dot, is almost exactly in line with the most likely set of forecasts from the Federal Open Markets Committee, which is a rate which is just below 4.5% at the end of this year. For 2023 as well, the two forecasts are very close, just over 4.5% for the federal funds rate. The first big divergence happens in 2024, when the market thinks that the Fed is going to start lowering interest rates, but the FOMC doesn't think that's going to happen. Now, what I expect will happen in December is all of these dots from the Fed will be revised upwards, because inflation is simply not slowing down fast enough. So the Fed is going to probably revise upwards all of the dots, and the market probably isn't going to like that. Looking beyond the equity market at corporate bonds, one useful measure to look at is the additional income you receive for taking the credit risk of particular bonds. So here it is broken down in these 4 panels according to the credit rating of each US bond. So here in the top panel is AAA, that's the highest credit quality. And here you get the tiniest credit spreads. Now, typically the credit spread is 0.67%, and that's also the dashed red line you can see, and currently we're below that credit spread. If we go to the other end of the credit spectrum to single B bonds, so these are deeply into junk territory, you can see that when there's a recession, these spike to over 10% spreads. But currently the spread is 4.8%, which is just in line with the long-term average. So certainly what the credit market is pricing in at the moment is completely normal conditions. It's not really pricing in any kind of recession, which many people expect in the United States. So this is not an asset class which I think currently is particularly attractive. Now, the all-in yield for junk bonds right now is pretty high because you have to add on top of this spread the risk-free rate. And risk-free rates have increased a lot over the course of 2022. But I still don't think there's enough credit spread priced into this market. So I personally don't think this is a good entry point for the US high yield market or for investment grade for that matter. Now let's look at a safe haven investment, which is gold. Now the two primary drivers of the price of gold are the value of the dollar, because it's priced in dollars, and when the dollar's weak, it pushes up the price of gold and vice versa. Well, it's been a tough 2022 because the dollar's been very strong, and that's until very recently. Similarly, if we look at real interest rates, those were negative since 2020, but recently they've surged upwards into positive territory and only fallen back very recently. Now, because gold doesn't generate an income, when interest rates are very high, that's fairly toxic for gold. So overall, it's been a very tough 2022 for gold. But as I mentioned, recently we've seen the value of the dollar fall back, and we've also seen real interest rates fall, both of which are good for gold, such that at the moment, gold looks underpriced by around 11%. So let me just briefly mention that members of PensionCraft, our online community, get access to this model and it's updated all the time. So here's that gold model you just saw, except you can zoom in on a particular region or look at any of the other models, such as silver, one for the federal funds rate, but also for UK and US house prices. And this is just one of the many trackers which we've now made available to members. But this is only available on our website, pensioncraft.com. But if you are interested in getting access to these trackers and all the other goodies which are part of membership, such as members-only videos, but also our chat application, so you can ask a question whenever you like, then just click on the link beside me or in the description beneath me. Vanguard produces a decade-long outlook and it forecasts returns across many different asset types. And what's really interesting at the moment is that the US is looking pretty poor in terms of its decade-long outlook. That's for its equity market. So here the returns are forecast to be between 4.7% and 6.7%. Why is that? Well, that's partly because of the very high valuation in the US relative to other countries. So if we look at global equities, that's why they have a much higher long-term return compared to the US. That's between 7.4 and 9.4. That's true of all global equities ex-US, but also developed and emerging market countries. What's also interesting is if you look at the fixed income space, the returns are now pretty good. So for US aggregate bonds between 4.1 and 5.1, that's not hugely less than you'll get from equity. And if we look at junk bonds, that's between 6.6 and 7.6. Also for emerging market sovereign bonds, 6.4 and 7.4. So certainly on the kind of risky end of the fixed income space, emerging market sovereign bonds and junk bonds, that is looking quite attractive. Over the near term, Vanguard's also quite pessimistic about recession in developed market countries, particularly the US, the Euro area, and the UK. All three of which Vanguard thinks have a 90% probability of a recession over the next year or so. Now, the reason for that is the synchronized tightening of monetary policy. That's true of all three regions. And also in all three regions, inflation is eroding consumer purchasing power. However, in Europe, we also have to contend with the Ukrainian war, creating this energy crisis. And in the UK, although they don't mention it, we have Brexit to contend with. So it's certainly not going to be a smooth decade, but we will have fairly good returns according to Vanguard if we look outside the US. Now, before we conclude, let me just mention base rates. You knew I couldn't avoid saying it. What are base rates? Well, these are the returns you'd expect if you didn't know anything else, if you didn't know there was an energy crisis or high inflation, because these are the average returns over a 120-year period. So for equity, the return above inflation has been 6.6% over that period. It's simply the best inflation-beating asset class that there is out there. Over the long term, bonds will return on average about 4% less every year. And bills, which are short-term government bonds, almost cash-like in fact, those return even less, just 0.8%. So if you don't know anything else and you're simply going to leave your portfolio alone for a long period of time, then you can see that it makes sense to put as much as possible into equities. So don't be terrified when you hear these negative news stories. Just remember what works over the long term. In conclusion then, I think the general backdrop for stocks in 2023 is fairly bleak. Not catastrophic, just weak, I'd say. And the primary reason for that is that we've got synchronized global policy rates which are being tightened. Central banks are raising interest rates across the world at exactly the same time, but also at exactly the same time that we're getting weakening global growth. Now, your allocation should depend on what you think is going to happen with two drivers. One driver is inflation, and if that falls as many central banks expect, that could cause equities to tear higher. Pulling in the opposite direction would be an earnings recession. In other words, profits for companies would fall dramatically as their margins are eroded by higher inflation, while simultaneously weak growth erodes their top line. So really it's a race between these two factors. On the positive side, it's certainly true that valuations are much more reasonable than they were at the beginning of the year. That's one benefit of a stock market fall, and that tends to increase long-term return. Another positive is that the Fed will start slowing its rate increases. It's said that it's going to keep rates at their high level for some time. That's until it's absolutely sure that it's quelled inflation at such high rates. But I think expecting a pivot is simply unrealistic over the course of 2023. So I think there's a bull case for 2023 and a bear case, and depending on which one you veer towards, you should tilt your portfolio accordingly. Starting with the bull case, if you think that rates are effectively going to trade sideways and not surge higher, and inflation's going to start falling, and that there's not going to be a particularly bad earnings recession, then I think that's a case for equity tearing higher. So I think stocks would be well placed to harvest that view. Developed market government bonds would also benefit from falling inflation, but generally the returns there would be lower than they would be for equity. And if we're looking at the types of stocks, well, growth, which is the factor that does so well when inflation is low, would probably benefit from this kind of environment, much more so than quality or value. So maybe this would be the kind of environment in which ARK-K, which is Cathie Wood's flagship fund, would do pretty well. The more bearish outcome would be if we get an earnings recession. So inflation doesn't fall as quickly as people expect. The Fed maybe carries on increasing its interest rates into 2023. And in this kind of environment, safe havens would do better. So gold would benefit, shorter duration developed market government bonds, so funds like SHY would also be protective of your capital. And in this kind of environment, quality, this would be companies without too much leverage, with good earnings growth, for example, but also high income, which is a style that's done very well over the course of this year, would continue to do well. And in this kind of environment, growth would do very badly. Now, in my personal portfolio, I've veered more towards the optimistic scenario, so I've been accelerating my drip feed into equity, but I think the really key drivers for next year will be inflation. Does it fall as many central banks expect? And also the earnings recession. Is that going to kick in, or will earnings be okay? So I think what you think matters much more than what I think, and I'd love to hear that in the comments below this video. Now, don't forget our offer if you want to get access to those trackers and also lots of goodies as members of PensionCraft. Then you can do that by clicking on the link beside me and in the description beneath me. And as always, thank you for listening.